Hi everyone, welcome to Value. So today we're going to talk about quarter one results for Tattoo Chef for 2022, and the market is not impressed. It is down over 8%. So we're going to look at the reasons why. So firstly, revenue rose 37.3% to 72 million for the first quarter, which is actually really good. Like, those growth results are still very good. We know as they kind of go throughout the year, the growth tends to slow down, but at 37% it is pretty good. Like, we're also seeing that the Tattoo Chef's branded products have increased 21.2% to 43 million, and it's 60% of total revenue. And we're watching their branded products slowly make the majority of their revenue as they try to step away from just doing other products for other companies. They're focusing on themselves, and I think that's probably a better approach. It also means better margins in the longer term. So we can see that, and we go, like, they're heading in the right direction of that. But what they're not heading into the right direction is the net loss. The net loss is at a whopping $17.6 million, which is, in a sense, it's okay, but not when you're running out of money, though. Like, if we come down right to the financial position of the company, at March the 31st, 2022, their cash and cash equivalents was $57.4 million. So these guys don't actually have very much in them before they're going to have to raise money, and it's likely they'll have to do it this year, probably within the next 3 to 6 months, which is, they're using a lot of cash. Like, they're using a lot. Which is, like, they need it for inventory, they need it for stuff like increasing marketing spend between 27 to 32 million, and then they've got capital expenditure on automation and robotics, which is 20 million. So you can imagine this company is actually really cash hungry, and that's what the market does not like about it in this environment. If it was like a year ago, market would be very hyped up about those growth rates, but we're in a different market now, and you just have to adapt to the different market and circumstances, and the loss is the one that's killing it right now. The people are looking at this and going 17.6 million in losses for the first quarter, likely very similar for the following quarters, and that's not going to bode very well. So hence why we're looking at the after hours, and it's over 8% down. So tomorrow when it opens up, we're going to see a negative share price for this company. And yeah, like, confidence is not great in its current market. So yeah, like, it's gonna get slaughtered. Wow, did you just see that? It just went negative 9.5%. So yeah, like, I think the stock's gonna get slaughtered tomorrow. That's the truth, because everyone can basically see they're running out of money. Everyone knows there's a dilution coming, and everyone's going to sell out. And yeah, basically, because I think people kind of had a little hope. That hope when you kind of like go, we're going to wait for the results, so potentially it might be good, so then we just hold. But I think based on that, this is as good as it gets in terms of revenue growth, which is actually quite good. Their Tattoo Chef branded products are actually, they're going to be the main focus going forward, but the losses are too large. The other positives is they added more than 10,000 new points of distribution. They commence production of frozen, ready-to-eat Mexican food items. So, you can, an enterprise-wide automation initiatives underway, expected to be completed by the end of 2022. So likely that they're putting in the money now to improve this automation, which you're not going to see the benefits until like end of the year till next year. So I think it's one of those things that, hey, it's cool. It's in a way, it's a nice company, but the valuation is too high and it's in the wrong environment right now. And basically, all the investors that are holding in the next 6 months, they're in for quite a painful time, because the things just don't look as bright while they're trying to grow and scale this company. But afterwards, like, it could look very, very nice afterwards. So potentially this is a company that is, prime for buying closer to the end of the year once they get all these things going. Or if the price drops extremely, extremely low. But like, it would have to be extremely low. Like, as I mentioned in a prior video that I did yesterday, you would probably have to look at a $4 price tag or so. That, like, I think the current valuation of this company is closer to 300 to 400 million rather than 600 million, which is not ideal, like, especially when you're looking how much it's dropped so far, and the fact that it could drop further, like, because the momentum's just really not in the stock. It is a period where they're basically scaling. They are also doing branded oat butter bars. Yeah, branded oat butter bars. So that's set to commence in Q2. So you can imagine new products, even more spend, even more marketing. They've got a cold storage facility operational from April 2022. This is one of those companies that's very mixed. Like, they've got a lot of good parts going for them, and they've also got a few bad parts. But I think in the current environment, the bad parts just really overwhelm the good parts. Where we go, it's a plant-based company, that's in a sense going to do very well in the future, but not at this valuation, and it's also losing money while its cash reserves are dwindling and they're going to have to raise money. So I think investors are going to look at those kind of points and kind of feel a little pessimistic about the company. Hence why in the shorter term the share price will not fare very well. In the longer term the company looks pretty good, but that's the longer term. You're going to have to go through a lot of pain before you see some good steady gains from this company. Potentially, if you're a long-term investor and you hold shares right now, you might be like, okay, I'm just gonna put them in the bottom drawer and be done with that. Or maybe if you're looking at buying, I don't think right now is the time to be buying because things do not look very nice so far. But that's just my perspective anyway. Let me know what your thoughts are. But overall, I thought I'd do an update because the Q1 results just came out, so why not do a video on this? But yeah, like, it's very similar to my prior video, that again the focus is on the cash reserves and they are dwindling. The losses are actually quite high in comparison because comparing to how much money they hold, they're not going to be able to last for too many quarters before they need to raise. And I think they're likely to raise within 3 months because it would be more prudent. But hey, if they don't want to go for a prudent approach and they're going for the whole, we're going to grow this company much larger, let people see the results, get the share price hyped up again before we raise, then that might be the case. But in this environment, it's really not the time to be raising money, but these guys will be forced to raise money. And with rising interest rates, like, capital is going to be expensive. Like, when interest rates were low, capital was cheap, that was the time to raise money. As you saw Virgin Galactic, they raised money at opportune times. Like, in hindsight, they were geniuses. But these guys, they did not raise money. And right now, dwindling cash reserves, a dwindling share price, they're not looking very smart right now. So yeah, we'll have to see how things pan out, but I think capital raising is very much on the cards. Until then, good luck investing, everyone.